Today's guest is John D'Agostino, the head of institutional at Coinbase. Coinbase is one of the largest crypto exchanges in the world, as is one of the prominent players at the forefront of the regulatory strategy in DC, as well as steering a lot of institutional adoption stateside and globally. John, we're excited to have you on. Welcome.
Thank you so much for having me.
Thanks for being here. To start off, we always like to ask our guests, what does crypto in America mean to you?
It's going to sound very cliche, but it means financial freedom and the ability to engage with money, which is by definition a government concept, but engage with money in a at least quasi-private manner and retain some that delicate tension we have between personal liberty and duty to the state, which we've balanced over the years in myriad ways through every aspect of our lives, right? Our privacy, our right to property and seizure, like all the things we've kind of worked out over the years through lawsuits and protests, that delicate balance between what we owe to the state and what we can retain as sovereign individuals that makes this country wonderful. I think money has gone too far in one direction. And I think crypto is an attempt to balance that out.
We honestly get a lot of people who reply financial freedom. So it's good alignment, honestly. Yeah.
No, I love that. Coinbase is the center of institutional crypto. Obviously, you guys are the biggest exchange in the United States and one of the biggest exchanges globally. But what major shifts have you seen in institutional behavior in the past 12 to 18 months? I imagine it's probably pretty monumental now that there is some regulatory clarity in the space. And I'm sure you can speak to some of those market trends, but curious what you've been seeing from a personal level where you sit and kind of give us an idea of those trends and what the public still might not understand about those institutional trends as opposed to retail.
So I will say I've always been a bit of a skeptic on the argument that the reason institutions haven't invested in anything, whether it's crypto or anything else, is regulatory clarity. And it's not to say that regulatory clarity is not important. Absolutely is important. It's wonderful that we're getting more clarity. That's great. But there's lots of asset classes and trades and things that institutional investors invest in that don't have clarity. And they do it en masse. So I would say regulatory clarity is important. It's top three. I would say first and foremost is liquidity. I'd say next is maybe regulatory clarity, and then right up there is alpha potential. And so if you've got liquidity and you have 2 out of 3, you have an investable asset class, because people will be willing to give up the certainty on the third in order to access it. If you've got liquidity and alpha, people will find a way. There are tons of things that investors do in massive size that there's still a grayish area. I'd encourage you to look up this very simple concept called season and sell if you don't know what it is. Season and sell is this wonderful thing where if you've got an offshore hedge fund and a domestic hedge fund, and you've got things in the domestic hedge fund that if you put them in the offshore hedge fund, they might get taxed, and they don't want to pay taxes because they're non-US citizens. You buy it for the US hedge fund, you wait 45 days, and then you sell it to your offshore hedge fund. And magically, so you season it, it waits around, and then you sell it. And magically, all that tax obligation goes away. And it's funny, if you talk to lawyers, hundreds of billions of dollars are used in this strategy. If you talk to lawyers, they're like, yeah, there's never any clear answer that this is right. Like there's no clear law or IRS rule that says this is okay. They could turn around tomorrow and say, all of that's nonsense, we're taxing you on everything. But it's this thing that people have done for a decade in the absence of any clarity. So long-winded way of saying, I think regulatory clarity is important, but that's not what was stopping predominantly institutional investors from getting in. I think it was liquidity. And I think specifically it was depth and breadth of liquidity. So what I mean by that is, and I learned this at the NYMEX a long time ago. I learned the difference between depth and breadth early on. So in 2002, the city of Houston was evacuated because of Hurricane Katrina around, I think it was 2002, 3, I forget exactly, but then. And the natural gas options market was this incredibly liquid market, traded millions and millions of dollars a day, notional. It just disappeared. It was gone. And we realized, oh, wow, there's like 12 hedge funds in Houston that were that entire market. And who would ever imagine Houston would get evacuated? That's like a crazy concept, right? So when the unthinkable happened, the entire market dried up because we didn't have breadth of market. We had depth, we had lots of volume, but we didn't have the different types of participants geographically, by size, by style. You need all different kinds. If everyone's on eBay trying to sell a bike, It doesn't matter if it's a billion people on eBay, you have no liquidity. If there's split between buyers and sellers, but every buyer wants a red bike, you also don't have liquidity. If every buyer is going to resell it, you don't have liquidity. So you need all these different hedge funds, speculators, commercials, retail, et cetera, to get good breadth. We are building that in crypto. It's getting there. The ETFs helped. So that's been the driver. And the last thing I'll say is there's this misnomer. I keep getting asked on panels, like, when will the wave of institutional investment come in? That's not how these guys invest. They're not lemmings. The pensions don't all get together in a room and say, let's all do a 5% allocation to crypto or anything else. They invest slowly and thematically over time as they see the liquidity being able to support their larger and larger position sizes. And it's just a grind. We saw it in commodities. We saw it in real assets. So there's no wave, but it's this gradual erosion as opposed to this crashing wave.
Yeah, John, you mentioned NYMEX, and you've been part of digitizing markets, I'll call it, for a long time. You're pretty instrumental in the creation of the Dubai Mercantile Exchange. You also, I think, speaking of liquidity, talked back in 2018 about a lot of those initial ICOs collapsing. In this notion of depth and breadth and liquidity, just from the previous cycles you've seen, what do you think crypto is missing, or what's the next phase here for sort of developing a more robust market? And then we can get into the history of Dubai and all that as well.
It's a great question, and thank you. I'm very flattered. Obviously, I was part of a team that did all that. I kind of got the credit because I was the leg man on the ground doing the work in the UAE. But it was a great team that built that exchange. I think crypto has to expand beyond crypto natives. And it's doing that. I mean, the ETFs were just a wonderful vehicle to make crypto ownership easier, accessible, and understandable. It has to be the narrative, the stories we tell about our asset class have to get cleaner and tighter. Partially because we did a bad job. We have some cleaning up to do. Crypto's had some. I wouldn't say I don't. No more scandals or no more problems from market structure perspective than any other asset class. I keep reminding people, in the same 12-month period or 18-month period that FTX blew up, the London Metals Exchange woke up one day and decided to cancel $16 billion of nickel trades. They just said, yep, we can't settle these trades. If we settle them, everybody goes bankrupt. So we're just canceling them, right? You're looking at me like I'm crazy. Maybe you haven't heard of it. If you haven't, that's okay. Very shockingly few people have. They literally just said, if we settle all these trades, the entire market will get upended. We'll have all these bankruptcies. So if you went to bed thinking you were up $100 on your nickel trades, you woke up being told, nope, we decayed. We killed all these trades. So I would ask you, if you are that person, how is that different from waking up and being told your FTX money is gone? It's been stolen. And in the case of FTX, a decent portion was recovered. In the case of the LME, everybody sued the exchange, and the London courts less than 8 months later said, nope, can't sue exchanges. Sorry, they have total rights over this. But nobody's questioning the integrity of the commodities market. But 3 to 5x the amount of money was stolen from people, just flat out stolen, than it was for FTX. So I think crypto gets unfairly maligned relative to other asset classes around kind of core infrastructure issues. But we have our jokers. Our jokers tend to be much more public. I think that's the problem. We tend to, for some reason, I'm not sure why we do this. We tend to push the jokers up to positions of prominence, whereas TradFi does a good job of hiding their jokers. I think I always say TradFi has more shame. Sometimes it feels like
we need to introduce
shame.
shame to crypto. Yes.
So we have a reputational hole to dig out of, and I think that's happening, and that's great. That's one piece, and then we have to in doing that, hopefully get, as I mentioned before, different types of participants, and specifically, Joel, we have to get participants. We have to be comfortable with the notion, I think, that people don't want to wake up every day thinking about their money as much as we do. I think that's one kind of mistake we make as an industry, is we imagine we have so many incredibly passionate people. Go on crypto Twitter, everyone's a monetary expert. They can walk you through the history of money and why hard money like Bitcoin is better than rehypothecated fiat. And it's all fascinating. But I think the average person, even the average sophisticated person, I'd argue even the average financially sophisticated person simply doesn't want to spend as much time thinking about this. And our stories tend to be and our narratives tend to be very complex around why crypto. It involves having to spend a lot of time thinking about the role of money in government, society, and culture. And people just don't, they want to do other things with their life. They don't want to have long-winded conversations about monetary debasement. So we just have to get better at that. We have to bring in, as I mentioned, other perspectives. We need reasons for others to enter this market. So the reason the ETFs, I think, were so incredibly impactful, not just getting more people onboarded, but also just from a market structure perspective, is the one thing I always felt was missing from Bitcoin. Let's say Bitcoin specifically, and I view it as a commodity. And that's my background, is commodity markets. And you could have something like gold, which has very like I think it's like 10 basis points of gold is used in physical applications. Like I don't consider jewelry physical applications, like industrial applications where it's chemically necessary to have gold. But that 10 basis points is very, very important. It underpins the integrity of the market. There were no, except for the miners, natural consumers of Bitcoin. There were people who wanted it, but that's different, like wanting jewelry. There were no forced buyers and sellers. And I just want to make sure that distinction is clear. Like if you have the natural gas market, there are companies that have to buy natural gas to make their products. There's a natural gun to the head buyer of that. There are natural gas production facilities that have to sell their natural gas to make money. They're natural organic sellers. Everyone else is a speculator for the most part. Bitcoin didn't have that. It had the miners, but that's about it. But the miners were like, we don't want to sell. So the ETFs, in my view, are kind of the surrogate commercial users of Bitcoin. They have to rebalance. It's codified into their business model. And that's a really good thing. That creates sort of a stabilizing force in that market. So we need more different people approaching the market for different reasons, to be somewhat ineloquent about it.
Yeah. On the spot Bitcoin ETF front, John, what have been some of like the flow patterns that you've been noticing that are telling us kind of how institutions are allocating and looking at this crypto market, especially compared to when they launched to where we are today?
Look, I think it's been remarkably resilient given spot prices recently. I mean, we saw what I'm encouraged by since October 10th, volatility aside, is we've had obviously 35% loss of value, but it's been a kind of steady grinding. It may be painful to wake up every day and see down another 4%, down another 6%, but from a market structure and integrity perspective, it is much, much better than waking up gapping down 20. That's what institutional investors look for, to say, wow, this liquidity is not it's way thinner than I thought it was. That is a massive, massive loss of confidence. So a grinding, methodical down or up market is not indicative of massive liquidity fracturing. It's also not indicative of the rumor mill, which was, we had some massive market maker doing a forced liquidation because they blew up. Every time we have a move in downside vol in crypto, that rumor gets put out there. I'm highly skeptical. Number one, if we did have that, everyone would know about it almost immediately. Like when Alameda was going under, I was getting phone calls 5 minutes after they were making phone calls. So this notion that you can hide some massive, like Eleanor would know before me. So like this notion that you can hide some massive, well, I mean a blow up, like a blow up. Like I have to sell right now or I go to jail blow up. Not the, this was really bad. I should shore up my balance sheet, take down risk methodically over the next couple of months. That's not a blow up.
So you're saying the ones today will be uncoverable then?
I think that's what's happening. I think October 10th, scared a lot of the market makers. I think they realized, wow, like my balance sheet, I thought my balance sheet was I thought I had 2x the balance sheet I needed to support my level of risk. Now I'm realizing in a situation like that, it's like 1x. And that makes me nervous. And I'm going to take down my risk and I'm going to try to strengthen my balance sheet. So there were a couple of phone calls made like a week after, with some of the market makers kind of calling around and saying, hey, maybe, how would you feel if I did a capital raise? And that spooked people because they were like, whoa, does this mean you're going under? That doesn't mean they're going under. That just means they're realizing, hey, I had these risk parameters and I thought the most vol would be is here. Turns out we had this event. which is the right thing to do, let me reset my risk parameters and let me strengthen my balance sheet to account for that possibility. That's what we want these guys to do. We don't want them saying, oh, well, that was a one-time thing, never happen again. But I think those calls spooked people. And that's why we're seeing continued sort of trepidation of stepping back into the market since the 10th.
Bitcoin might sound complicated, but the Gemini credit card makes it simple. Use it like any credit card. Buy lunch, gas, or your weekly groceries, and you'll earn up to 4% back instantly in Bitcoin or one of over 50 other cryptos straight to your account. No annual fee, and right now you can grab a $200 Bitcoin intro bonus. It's the easiest way to start building your Bitcoin stash. Go to Gemini.com/CIA to learn more. Terms apply.
John, it makes sense that ETFs would provide this sort of stabilizing base or this new class of market participants. We've talked about some of I think you called them jokers, but some of the folks in the industry who are maybe a little more risk forward. What do you think of the role of leverage and perpetual futures as in terms of what happened on 1010, but also just as sort of like a counterweight or like a necessary part of liquidity in these markets?
I love this topic. So first of all, just to be clear, I don't mind the risk takers. Like the degens are not what I'm talking about. Like you want to degen into like a meme coin. God bless you. It's a free country. Do what you want. I don't mean that when I say jokers.
Yeah.
I mean the folks who are embarrassing our industry, and I think we all know what I mean. What I mean by that. What I mean by that. So I think it's the individuals who are presenting crypto as this sort of toxic, overly aggressive, that have fun staying poor, kind of like arrogance. Like that's what I'm talking about. We have to be likability is really important. We have to be a likable asset class full of likable people that don't expect everyone to spend all day long thinking about their money. If we can pivot into that, and not a huge pivot, but if there's lots of wonderful people within crypto. I think we just have to give them a bigger platform and not highlight the toxic ones. So which represent a very small minority. So look, I think the derivatives space is profoundly important. Number one, for most asset classes, equities, fixed income, commodities, the derivatives market dwarfs the spot market by multiples. And there's a reason for that. It's cheaper to enter into. It provides leverage in some instances, implicit leverage. When you buy a future, you put down 5 or 10%, so you're implicitly levered. And same thing for options. And there's the cheaper, more complex, but more sophisticated ways to put on exposure. And institutions love that. They're also a little bit more opaque in terms of pricing. And so institutions love that because they can find pricing anomalies a little bit easier than they can for spot markets. So if you don't have a healthy, and what about derivatives markets is by definition, they go out into the future. And so let's just use commodities, for example. Like, so why is a commodities derivatives market so important? Let's say you want to build a crude oil facility. You've got this wonderful thing called the futures curve that can extend out years. So you can walk into a bank and say, "Hey, look, I think I have an ability to find and process crude oil." And the bank says, "Great, but what if the price of crude oil collapses?" And you say, "Oh, it's wonderful. I can hedge out my exposure for years using this futures curve." And that allows the bank to loan you the money to build that plant. So that existence of that futures curve creates liquidity in the futures curve itself, opportunities for P&L, opportunities for building facilities in real time, providing jobs, pay, taxes, and also the credit market has expanded as well. So that derivatives market is this sort of like, I used to call them like a stadium. When I was building the Dubai Mercantile Exchange, that was my analogy. Think of it like you're building a soccer stadium or a football stadium, and all the different businesses that surround it will flourish off of that stadium. And so credit markets flourish, et cetera, all because of those derivatives markets. So I think they're arguably even more important than the spot market, even though they're derived from the spot market. Perps are really efficient vehicles. Nobody likes to buy a future, and like we used to joke in the NYMEX, like, if you mess up your calendar, somebody would call you and say, "Where do you want those 10,000 barrels of crude oil delivered, sir?" Like, like that. That's scary, right? And we had an exchange vehicle where you could but that happened. Like that actually happened. People
Like
would like mess up
2021,
their
right?
math,
Mm-hmm.
and they'd be like, oh, where should this palladium be delivered, sir? And you have to pay a fee to get out of that physical deliverability. There are nice things about physical deliverability. It kind of forces the market to center around a price, but the perps funding rate, provides that mechanism. So they're really, really super efficient. They open up the market to tons of different types of institutional participants who maybe don't want to get into the weeds around storing or holding crypto, but feel very, very comfortable with that options math on and that futures math on that end, and it just opens up the funnel to bring many more participants in.
John, I want to ask you about the notion of Bitcoin as digital gold. I think you've made the comparison once or twice before. It's something that we've heard Larry Fink of BlackRock say, and actually a lot of institutional, heads of Wall Street companies have alluded to it as well. Curious to know how that narrative is holding as we've seen Bitcoin's ebbs and flows over the last couple of weeks to months, right? I mean, we saw the high of 126,000 last month. I just checked, it's down around, 84 or 86,000. Is that still, a viable narrative around institutions, them calling it sort of a store of value, a hedge against inflation, or is it still considered a volatile risk-on asset?
So two things can be true at the same time. Gold goes through many, many bad volatile periods. If you were holding gold during the great financial crisis, those first 7 months, it lost a third of its value at the worst possible time, right when it was supposed to hold its value. It recovered over the following years. But again, if we were sitting here in 2008, we'd be having this, you'd be able to say the same exact thing about gold. Should we trust gold anymore? Like right when the world needed it, gold lost a third of its value. So the unfair argument, Eleanor, is that all I have to do in this situation when confronted with this is I have to just back out the time horizon, right? And it's kind of a cheap argument. I don't like making it. It's a good argument because again, you should think about stores of value longer than a year. I don't know about maybe 50, but somewhere in like I like 7-year ranges. So like somewhere in the 7 to 10 year range is where you probably should be thinking about store of value. If not longer. So I think it's a cheap argument in some ways, but it is the right argument. And I would make that same argument for gold. I would make that same argument for commodities like crude oil. Like, remember, let's not forget, crude oil went negative.
Mm-hmm.
Less than 2.5 years ago, you had to pay someone to take delivery of the world's most important commodity. It was insane. But at the time, you catching a falling knife, right? But obviously buying crude oil at negative would have been a good trade. So I do think for these things that are stores of value, you have to back up and you have to say to yourself, okay, has the fundamental thesis changed for Bitcoin? The only thing I see changing in the last 2 months for Bitcoin is I think the New York elections and other elections kind of maybe hinted, hey, the Democrats might take power back. I'm not a policy guy, so I won't try to opine on that. But maybe to me, that's in the last 2 months, the only fundamental thing I've seen change is like a little bit of wobbling around. Hey, we're going to 2 months ago, I thought we thought as a country, we're going to have this very, very pro crypto administration in kind of dominant power position almost, for the next like 5 years. And I think the elections maybe kind of made people a little nervous that the Democrats might take power and some of them might not like crypto. Outside of that, I don't know what's different from 2.5 months ago when we hit the all-time highs. Or whenever we hit the all-time highs. So I think we're looking for a clearing price right now, which is a function of another way of saying we're looking for confidence that the market makers are actually okay, and they're there. Because remember, unlike equities, the market makers in crypto and commodities don't have to put up a bid ask; they're on a voluntary basis. So if they're hurt, we wouldn't know. And I think until that confidence happens, we won't see Bitcoin recover. But I do think the narrative of Bitcoin as gold or gold complementary to gold. By the way, I don't think they're mutually exclusive. The smartest investors. I was on the board of Tudor when Tudor announced they were using Bitcoin as an element of their long-term inflation hedging portfolio. They didn't replace gold with Bitcoin. They built out a model that showed that with a kind of I think it was a 4% allocation to Bitcoin. That produced a much better inflation hedge over long periods alongside gold, some baskets of commodities and real estate. So it's not either or. And there'll be periods where where hopefully you invite me back and I'll say, yeah, Bitcoin's crushing gold over this 12-month period, and I'll defend gold at that time.
Yeah, John, I also want to ask you about your past life. I know you were the focus of a book called Rigged, which is the true story of an Ivy League kid who changed the world of oil. Throughout this recording, I know you were a kid at the time. Now you're an adult.
Yeah, I was a kid.
You talked about Houston. You talked about oil trading. You talked about the futures, the barrels, everything. I used to cover oil trading futures as well and energy markets at Bloomberg and S&P before crypto. Now I'm all crypto all the time. But I could kind of, understand like the analogies that you're making here, but I think for our listeners, it would be extremely valuable to kind of hear how you tie your past life there into the way you look at the crypto markets today, right? Because like in my mind, I also see a few similarities, but a ton of differences. So how does it kind of play into your perspective?
Yeah, there's a lot of differences, and I try really hard not to force fit the crypto narrative into the commodities narrative, but a couple of things that are similar. You have, again, even in a mature market in commodities, you have inherent volatility. And that volatility is driven by a couple of market structure things, like, for example, the market structure I just mentioned, where the market makers don't have to post bid-ask spreads. That's a core element of why you have kind of a little bit higher propensity for unusual vol activity. It's to some degree a function of the fact that commodities, and I would argue to some degree Bitcoin, they're priced by the marginal unit of production. What I mean by that is you could find out tomorrow that the US uncovered a trillion barrels of crude oil 5,000 feet below the ocean floor. That's great. And in theory, that should say, oh, crude oil should drop, precipitously because we've just found 50 times the amount of crude oil that we knew existed. It's irrelevant to some degree. It's all about what you can extract. Because if the extraction cost is $10,000 a barrel, and or we run into a supply problem, and that individual who wants to power their plant is willing to, and this literally happens, like the container ship full of crude oil will be sailing in one direction. They'll call up the broker and say, "I'll pay more for that because I want it right now." And they'll turn the ship around, and the ship will go back and forth via a bidding war. Like that's literally physically what could happen. And so when you have the marginal unit of production setting the price, the amount of supply you have is completely irrelevant. And so Bitcoin miners, hash rate's going up. It's getting harder and harder to produce Bitcoin. And if demand exceeds supply, there'll be bidding frenzy over those marginal units of production. And then the scarcity adds to that. The fact that we know we're not going to wake up one day and uncover a trillion Bitcoin somewhere. So that's why it kind of feels the same. It also feels the same because the markets are, I wouldn't say they're more heavily retail than commodities, but the retail behaves like institutions. You have a lot of power users, a lot of whales, and they sort of behave like institutions, which is the way commodity markets behaved. And then the personalities, for sure. The YOLOing into risk personalities are it's the same, except the NYMEX guys were arguably worse, not even as well dressed as the crypto guys. The crypto guys get a lot of crap for wearing hoodies, but the NYMEX guys were like stained, gross, like shirts. So
I've never heard that crypto guys dress better.
They're the same. And there's so many commodities folks that went into crypto because they're. It's like I'll wake up and I'll do an interview and they'll say, oh, Bitcoin's down 4%. Is everything okay? And I'm like, this is nothing compared to natural gas volatility. Like this is boring to me. So I think that's the reason the commodities folks do well in crypto.
John, I got to get your take on the current state of debanking in the U.S. We had a report out recently from the House Financial Services Committee that basically was sort of an overview of, well, more than an overview, it was a 50-page in-depth report about what happened with debanking under the Biden administration, the agencies that were involved, the key players, and you were named in the report as someone who contributed to it. I'd like to get your take on kind of where we stand now. We obviously had those hearings back in February with the Senate Banking Committee, House Financial Services Committee. basically uncovered everything that happened, right? We saw recently another case of debanking with Jack Mallers, the Strike CEO with JP Morgan. We chatted about this on our Friday show. Gerald made the joke that it was maybe more notable that Jack Mallers actually had a JP Morgan bank account in the first place. But curious to know, do you think this is still an ongoing issue? And, even though it's being called out and the Trump administration is trying hard to crack down on it, are we out of the woods yet when it comes to this systemic discrimination against crypto companies and crypto businesses and individuals?
So no, I don't think it's done. I think it's much better. It was absurdly systematic, and the defense against it is going to be, and we've seen this from some of the anti-crypto folks on Twitter. The defense is going to be very simple. It's going to be, wait a second, you're mistaking debanking for executives and banks making prudent risk decisions. And that's fair. They're allowed to make those risk decisions. So what we did, and I saw that happening during the peak of the is it real? Is debanking real? I noticed the opposition crystallizing around what is actually a very effective rhetorical point. And I remember thinking like, okay, that's not good, because that's a good argument. And I know that's nonsense. I know they're lying, but how do I prove it? And so the thing that got mentioned in the Senate report, because it got mentioned in the congressional oversight hearing, was I'm on the board of AIMA. AIMA is the Alternative Investment Management Association. It's one of the largest lobbying groups for funds in the world. And I asked AIMA if they would help me put together a survey of AIMA members for two reasons. One, I thought it was really, really important to make sure that I had a control group of non-crypto funds to bolster the statistical relevance of the study. And secondly, I wanted a wide enough audience of survey participants because I really wanted to make sure that I focused exclusively on simple banking. Right? This wasn't because again, if a crypto hedge fund goes to a bank that doesn't do crypto and says, we want you to take extraordinary balance sheet risk or anything like that, it's fair for that bank to say no. They would say no maybe for commodities or for real assets or anything outside their kind of wheelhouse. And I really needed survey results that spoke to the simplest, least risky form of banking. So I focused on subscription redemption accounts, which is literally just cash in, cash out, fiat. So you form a hedge fund and people have to wire you money for your hedge fund. So you have to open up what basically is a glorified checking account. And they wire the money to that account, and then you wire it out to whatever exchanges or whatever you want to do, and that's easy businesses for banks. They get a deposit fee. It looks good on their balance sheet because they've got billions of dollars coming in and coming out, and so banks don't tend to turn down that business. It's also a way in for them because they figure, okay, well, even though they don't make a ton of money off of it, but it's no risk for them. It's just a checking account, and even if maybe this hedge fund manager becomes really, really wealthy and I'll get her private banking business. So they love it. They see it as like a loss leader to get this private banking business. And we found that, on an absurd scale, like 5 or 6 times more likely, crypto hedge funds were being turned down for this very, very simple banking request. So we knew it was happening. It's still happening. It's happening less. The excuses now are, oh, you're too small, because crypto funds tend to be smaller, and those are hard objections to overcome, because again, it's fair. Banks don't like having a million small accounts. They may say, okay, you're opening up a $10 million crypto hedge fund that just doesn't meet our minimums, so they can raise their minimums. So, but it is much better. I think a lot's going to depend on what the consequences are. Like if people don't lose their jobs, I mean, the ones who didn't naturally go out through attrition over the switch over, if there isn't a purging of those individuals, it'll stay there, and it might get worse because those individuals might feel they want revenge at some point. So I think they broke the rules. They didn't treat customers fairly, and they shouldn't. I'm not looking. Some people are calling for jail and stuff. I don't think that's a good idea, but I think those individuals should not be in those positions of authority at those banks if they got caught up in that fervor over pushing back on crypto hedge funds.
Yeah. So John, there's the survey and sort of the self-reported aspect of debanking, which I think, to your point, on crypto Twitter gets a lot debated quite a bit, and mainstream media debates it quite a bit. Like if you say you got debanked, to your point, Did you just, do something sketchy, or you weren't big enough right there? Those types of cases. We've had Paul on the show a couple times, so maybe this is more of a question for Paul, but Coinbase has also been very adamant about finding out what the regulators were saying to each other, right? So all these FOIA requests that you went through this process. How do you see sort of the conversations that were happening within the regulators and the institutions maybe changing now that they know that there's this level of skepticism, and obviously the American people have a right to get those records? Or do you think it is just this notion that these individuals just kind of circulate in the government and we just need to pull them out?
So I'm not, again, with the caveat of I'm not a policy
Of course.
guy.
Yeah.
However, one thing I can say is before I joined Coinbase, I had a wonderful relationship with the SEC. This is pre-Gensler. This is under Commissioners Piwawar and Chair Clayton. I would go there once a quarter, and I would lecture to a 50 or 60 SEC staff members on general market structure, including crypto. I teach a class at MIT in fintech, and I would bring some of the research that we did at MIT to the SEC. And I did that for almost 7 years. I think it was 2019. I think I was invited down to speak at their annual fintech session. So I am a big fan of the SEC, and I think sometimes we're a little too critical of staff. They're not technically incompetent. They have a deep understanding of technology, and even back then, when there was some crypto skepticism among some of the people I spoke to, it was good natured. It was thoughtful. It was the type of skepticism that we should be encouraging. Something changed. I won't go into detail on it because I don't know what it was. I don't know what it became highly political. It became highly personal. Like it was bizarrely personal. And I always try to, whenever these situations occur, I try to think, what have I done to make this happen? So maybe we were too aggressive. Maybe who knows? But it's like a family dinner. It got really, really tense. Nobody trusted each other. And then everyone just kind of spiraled into this negativity, and it became highly personal. And these government employees are just people. So, they get a sense of the top as to who's on the most wanted list, and they're going to text each other, and they're going to have, they have their own personal relationships. They're going to try to think about, how do I advance my career within an organization like the SEC and CFTC, because they want to advance their career. And so if your boss hates something, like viscerally hates something, whether or not your boss tells you to go kill it, you're going to get into your boss's good graces if you are against that thing too. That just makes sense, right? So I don't blame them for hardening against something that they knew, if I'm going to be successful in this agency, I have to show that I'm tough on this thing. So I have no doubt there were tons of texts flying around because they thought they were in the right. They thought they had the law on their side. They thought they had the rules on their side. They certainly had the chairman on their side. So if you were at the SEC, I try to assume the best in people. Everyone I know at the SEC at staff is a quality individual, smart, wants to do the right thing for the country, believes they are serving a social good at the junior levels. A lot of them left when he took over and started this movement against crypto, but some stayed, and I don't think they're bad people because they stayed. And so naturally, I assume they fell into line, and they said, "Okay, I'm on Team Gensler now." And I'm sure there were tons of tests going back and forth. So will it change temporarily because people now are going to be embarrassed and know that those texts are going to be, but longer term, I think that always exists within organizations. But yeah, I think for at least one election cycle, people will be a little. I think the bigger issue, the bigger change is coming from this incredible cooperation we're seeing between SEC and CFTC. Right, we have never seen this in our lifetime. Two agencies led by people who say, I'm going to put my personal career, and I'm going to put, I'm instead of grubbing for money, right? Instead of like fighting with the other agency because I want the lion's share of the funding, I'm going to do what's best for the country and promote innovation in a collaborative manner, even if it means I'm giving up control of things. We have chair people who are volunteering and saying, hey, maybe this doesn't belong in my agency. Maybe it belongs in your agency. That's crazy. In a good way, right? For years, it was the opposite. For years, it was, I'm going to grab even if it means we're overseeing the same thing. I'm never going to let go of any authority, because letting go of authority means letting go of funding. And that was always the rationale behind building and building up. Now we have the opposite. So I'm excited to see how much of this the fat can be stripped away during this cycle with these really amazing people putting country ahead of personal.
With that said, though, would you say that passing a market structure bill is crucial because there could be that change in 3 years or so where the agency heads change and another party comes into play, and all of a sudden we have another Gary Gensler and another anti-crypto CFTC chair?
So everyone always asks, I get institutional investors ask a lot, like, how durable is this change in the administration's friendliness? And it's a fair question. I do think we won't see a politician running on an anti-crypto agenda for some time. I could be wrong. Again, I'm not a policy guy, but I feel like that ship has sailed because I don't know I don't know what voter you pick up. I mean, my mother, if you say, I remember one time, I won't name names. I remember a Democratic, an individual running for office said to me, well, I have polling that shows that like 65% or 70% of Americans, when they hear the word crypto, they have a negative reaction. I'm like, okay, but substitute the word crypto with swaps, options, swaptions, derivatives, Wall Street. Any of those words produce that same kind of like, I don't understand it. It seems complex. The follow-up question should be, do you care enough about this to vote on it? I'll vote on the issue.
Right.
And I don't know a single person, and I know some virulently anti-crypto people. Even these people.
Yeah.
I mean, I'm very dear friends with Nouriel Ravini. I have been for 20 years, and I'll be until I die because he's a wonderful human being. I don't think Nouriel's voting on crypto as much as despite his feelings.
Army.
My mother is like, what do you do again? What's this Bitcoin stuff? She's not voting on crypto.
Right.
But 60 million or so Americans are voting pro crypto. So I think those days are over because you gain 0 votes, you lose a lot. But for the other stuff, you're right. I mean, executive orders can do a whole lot. So I think codifying it into resilient law is really, really important.
I want to ask about how Coinbase is specifically approaching this from a product and sort of liquidity stack perspective, right? You've seen Chair Atkins talk about super apps, and that's sort of a notion. Coinbase has obviously been very busy on sort of the M&A side, acquiring Echo, acquiring Deribit, right? And then also launching this product. I think Monad was the first one to use this new platform. Can you just talk a little bit about, you seem to be very confident, or Coinbase does as an institution, very confident that this sort of super app and this blending of SEC and CFTC regulation is going to work out. And so how are you guys approaching that from a kind of liquidity stack, basically all the way from like a private capital raise going out into sort of futures and derivatives market?
I'm glad you brought that up because I think the Echo Monad issuance was underreported. Not by you, of course, but I think it's a bigger deal than people are saying.
We saw
are making out. I think it's a huge deal because look, Brian Armstrong's on record saying we want to be the everything app. Super enthusiastic about this, given this improved cooperation between SEC and CFTC. It seems like that's where the world and the country is headed. Could a new administration come in that delays that by a number of years? Sure. But it's clear to me that that's where we're going. Now, whether it's going to be in my lifetime or my daughter's lifetime, I have no idea. But this notion of like value being stored across entirely different systems and entirely different regulatory structures is just highly inefficient. And we tend over time to move towards efficient outcomes. So I think that's going to happen. The reason that Monad, I think, was so huge is that what will speed that up. So 2 things will speed that up. One is what we have now, which is this like kind of once in a lifetime, open-minded, evangelical type regulatory environment, which is willing to break things and rebuild it to make it better. That's awesome, but you can't count on another one of those. I hope we have this for a while, but you can't count on that. But what can absolutely move things along, secondly, is obviously market structure bills, but success. And so, before I talked about this whole season and sell thing, the reason the probability of season and sell being overturned is its success. There's now hundreds of billions of dollars flowing through that model. So to unwind all of that is virtually unthinkable. It's virtually impossible. So Monad was a absolute home run. In the course of, I think, 7 to 10 business days, 200, I want to get the numbers right. I think it was roughly 260 million. I don't have the numbers in front of me. My screen went dark. But north around $250 million was raised, which was I think 1.4 times oversubscribed. 80,000 participants. I think the average dollar amount was a little under $3,000. The highest dollar amount was only 57,000. So this was a truly public, I won't say decentralized, obviously, but widely distributed utility token capital raise that did not involve underwriters, did not involve individuals just randomly assigning pricing. And the asset performed well in the weeks after the listing. So this is everything you want to see from a new issuance, a new listing. Keep in mind, NASDAQ is NASDAQ because they listed Microsoft a long time ago when nobody else wanted to touch these tech companies. So liquidity pools, exchanges, whatever you want to call Echo, can be built off of big wins. And I think this was a massive monster win. It's really hard to pull that off. It's really hard to get that type of steady issuance without an army of salespeople working the phones. And I was incredibly skeptical that it could happen. And I was 100 million % wrong, because I really thought we're still in a day where these assets were mostly sold, not bought, where you needed, and maybe it's not like phone brokers like I used to know, but maybe it's Instagram influencers or Twitter influencers, but you needed that army of influencers, that army of salespeople to get that distribution. And Echo just proved you don't, quite frankly. So I think, now we'll see, like fingers crossed, like can we repeat that 2, 5, 7, 10 times? And then even more importantly, can we keep the quality of those issuances high? They're not all going to be winners, but you want to avoid having too many dogs in those early days. If you pull that off, you have reinvented capital formation in a much safer way for people, in a better, safer way. And that's extraordinary.
I have to ask just real quick on that point, because you mentioned kind of the participants. There's been a lot of chatter on Twitter recently about sort of transfer restrictions and kind of some of these other features of offerings. Do you see something like a transfer restriction as like a feature or a bug of the system, the way you guys see it playing out?
I wouldn't even call the restrictions. I see the rule set that have been defined. So I read the rule set. I didn't create it, but I read it. I thought they did a very, very good job of putting in place really basic, simple rules to try to increase the probability of overall market integrity. And, the rules are the rules. So anyone complaining, I'd say to them, don't buy something where you don't understand the rules. The rules weren't imposed after the fact. And if you're worried about these relatively benign transfer restrictions or holding restrictions, I'd step back and ask yourself, why was this so successful? Why has the token done well post-sale? Why was it so well distributed? I believe the integrity of that market, which is based upon those rules, was part of that. I want to, and I believe I can speak for the team, and if hopefully I'm not speaking out of turn, they want to disincentivize the wrong type of market participant. And so, again, if those rules were placed on after the fact, I stand corrected. I don't think that was the case. But if those were the transfer restrictions from the beginning, that's part of what is making this thing successful.
I guess it's because people can't just like buy and sell, right? Is that what you're kind of saying?
Yeah, there's a set of rules around.
It's incentivizing. I wouldn't say long-term holding, but it's disincentivizing quick flips.
Yeah, John, it's also you said it was a home run, and honestly, in the end, it did all sell out for the Monad token sale. But I remember like a day in, I think it was like 50%, and everyone in crypto is like, "Oh, this is a flop! Like nobody's buying it," and like everyone in crypto wants everything like so quick, right?
We got to get out of that mentality. We have to get out of that mentality.
Yeah.
It makes me nervous if something sells out in seconds. That means it was pre-sold. That means it was poorly priced. Like that is taking a week to thoughtfully build a book for a $250 million book in a complex asset. That makes sense. Unless if there were bots buying it, that doesn't make sense. But these are human beings making these investment decisions, and that tendency of crypto to like speak negatively about things that don't happen instantaneously is a bug, not a feature.
At least we have that. At least we haven't got bots buying tokens yet.
Not yet. Very soon. Agentic payments coming soon.
There's got to be some bots out there buying stuff. Yeah.
They're maybe not making the investment decisions, but they're certainly doing the buying.
Yeah.
John, just quickly on the Coinbase side of things, for an institutional point of view, what are institutions really focused on right now? Like, what do they want out of Coinbase products? Is it staking? Is it custody? Is it tokenization? Like, there's so many different narratives I feel like we've been touching on this year that are popular in crypto right now. And it's probably just 3 of maybe 6 or 7 of the top ones. What would you say institutions are kind of asking for from Coinbase products at the moment?
So I think the urgency is around custody, staking, and lending. Tokenization is on everyone's watch list. Tokenization is it's like quantum, right? Everyone knows it's going to change the world. People are trying to figure out, well, how short-term profitable is it going to be? Nobody wants to be first. Tokenization is one of those things where it's I look at it and say, I've never been more confident that something is going to be the dominant mechanism in the future. I just can't tell you when it's going to take over. But it's clearly a much better way to do it. It's like when I went on the NYMEX floor. When I graduated from business school, I got a job on the NYMEX floor, and I walked on. And this isn't like 1920. This is 2003. It was open outcry, and the whole world had gone digital. NYMEX was still 850 guys screaming, yelling, and doing crazy hand signals. And I sat there thinking, obviously, this is going to turn electronic. Clearly, this is going to happen. But it took 10 more years than I thought it would, because lots of crazy, I got punched in the back of the head and knocked out on the floor because I was accused of trying to digitize the exchange. So there were lots of reasons why. It stayed that way. So I don't know how long it's going to take, but tokenization is going to eat the world. There's no question. But right down today, urgently, super interested in earning yield in a safe way, whether it's through Coinbase or through Coinbase Asset Management. Super interested in qualified custodians. And super interested in lending, both as an asset provider, lending, providing capital for us to lend through Coinbase, and also borrowing from Coinbase.
Yeah. All right. Last thing, John, what is something that you're paying attention to that you think others should as well, that we haven't already discussed?
Oh, that's a good question. The Czech National Bank.
Go on.
Starting to test.
Yeah.
I don't know. So I don't know what I'm allowed to say, but the Czech National Bank chose very well in their service providers. I will give them kudos for who they chose for their service providers. And the fact that an Eurozone central bank is taking on, it's a small amount, it's $1 million of Bitcoin, but they're putting Bitcoin on their national treasury, and they are experimenting with and learning in real time using Bitcoin for payments. That is big. No disrespect to El Salvador, no disrespect to some of the other countries that have chosen to do it. This wasn't I want to shake up my economy and because I'm heading in the wrong direction, and I want to pivot using Bitcoin as to some degree, speculative tool. That I admire that decision on behalf of El Salvador. But we are a stable Eurozone country. We don't have to do this. We have access to the EU window. We have access to EU borrow. But we are going to go through all the bells and whistles, do the RFP, choose the vendors, and we are going to make it national policy to begin to experiment with this asset. That type of thing is contagious, and I can see more Eurozone companies following suit very, very shortly.
Sometimes we get sports references like, what are you watching? Oh, the Kansas City Chiefs. So that one is memorable.
That was a real
John.
answer.
Thank you.
Czech National Bank. Yeah.
Oh, I was supposed to say something interesting.
No.
That was pretty interesting.
It's usually when someone can't think of something that we haven't already talked about. So no, we love that answer. Thank you.
Yeah.
This has been great.
Yes. Thank you so much for coming on.
Thanks so much for having me. This time flew by.
Yes. Thank you, John. We appreciate it.
Look
Cheers,
forward to
have a
having you
wonderful
back.
Thanks.
Thanks, John.